The year is 2025. The stock market, that beast of greed and fear, continues its relentless climb. Yet beneath the surface, a tremor, a shiver, the faintest scent of fear in the air. Those who've seen it before, those who know the beast's true nature are watching, waiting, because in the stock market, as in life, what goes up must eventually come down. History is littered with the wreckage of financial crises, the dot-com bubble, the housing crisis. Each time the warning signs were there for those who cared to look, ignored by many, dismissed as noise by others. But for those who paid attention, the signals were clear, ominous, like the distant rumble of thunder on a sunny day. Today, as we stand at the precipice of what could be another tumultuous period, it is more crucial than ever to heed the warning signs, to separate the noise from the signal, to understand the forces at play that could send the market tumbling down. This is not a time for complacency, it is a time for vigilance. The lifeblood of any economy is consumer spending, and consumer spending is driven by one thing: confidence. When people feel good about the future, they open their wallets. They buy cars, houses, gadgets, they invest in the market. This confidence, this belief in a brighter tomorrow, is what fuels economic growth. But what happens when that confidence wanes? When the headlines are filled with talk of inflation, market volatility, and global uncertainty, consumers get nervous, they tighten their belts, they delay big purchases, they pull back from the market. This decline in consumer confidence is like a slow poison, gradually weakening the foundation of the economy. And the market, always sensitive to the winds of change, begins to react. Stock prices wobble, investors become skittish. The once unstoppable bull market starts to look a little less certain. Inflation, that silent thief, is back. For years it lurked in the shadows, kept at bay by low interest rates and a relatively stable global economy. But now, fueled by supply chain disruptions, rising energy costs, and loose monetary policy, inflation is rearing its ugly head. Prices are rising on everything from groceries to gasoline. Wages, while increasing, are struggling to keep pace. The purchasing power of consumers is being eroded, forcing them to make difficult choices. This resurgence of inflation is a cause for concern for investors. Companies are facing higher input costs, which they are forced to pass on to consumers in the form of higher prices. This can lead to a decline in demand, hurting corporate profits and ultimately impacting stock prices. The world is an interconnected place. What happens in one corner of the globe can have ripple effects that are felt far and wide. And right now, the world is a very uncertain place. Geopolitical tensions are running high, trade wars are simmering. The pandemic, though receding, continues to cast a long shadow. All of this uncertainty is making investors nervous. The stock market, which hates uncertainty more than anything, is reacting accordingly. Volatility is on the rise. Swings of several percentage points in a single day are becoming more common. Investors are flocking to safe haven assets like gold and bonds, driving their prices higher. The retail sector, that bellwether of the economy, is flashing warning signs. The retail sector ETF, XRT, a basket of stocks that tracks the performance of the retail industry, has broken below its 50-week moving average, a key technical indicator. This break below the 50 WMA is significant because it suggests that the momentum in the retail sector has shifted. After a period of strength, investors are starting to sell off retail stocks, indicating a lack of confidence in the sector's future prospects. This weakness in the retail sector is a worrying sign for the broader economy. It suggests that consumers are pulling back on spending, which could have a ripple effect on corporate earnings and economic growth. Sometimes the stock market gives us early warnings, like a canary in a coal mine. These warnings can signal potential dangers ahead. It's crucial to pay attention to these signs, even if they seem minor at first glance. They can help investors make informed decisions and avoid potential pitfalls. When technical signals flash red, it's a sign that something might be off. These signals can include things like declining volume, moving averages crossing, or increased volatility. It's important to not ignore these indicators, as they can provide valuable insights into the market's direction. Staying vigilant and monitoring these signals can help investors navigate through uncertain times. Sometimes the market presents a mixed bag of signals. In these situations, some indicators might be positive, while others are negative. This can make it challenging to determine the overall market trend. It's essential to consider all available information and not rely solely on one or two indicators. A comprehensive analysis can provide a clearer picture and help investors make balanced decisions. Preparing for a potential market storm involves taking proactive steps. This can include diversifying your portfolio, setting stop-loss orders, and keeping an eye on economic indicators. It's also wise to stay informed and adapt to changing conditions. By being prepared, investors can better weather the storm and protect their investments from significant losses. If you want more news, subscribe now and become part of an engaged and discerning audience.